And here joining me with some other names to watch, Diane King Hall is with me, and looking at the rally that we are seeing in a name called Intuitive Surgical. Now this one up here.
Yes, double-digit move off the back of this. And this has to do with basically people during the pandemic putting off all those procedures. So Intuitive Surgical, the beneficiary of that, a lot of that has to do with their Vinci robotic system. So they beat expectations. Let me take you through some of the headline numbers. $2.40 per share was earnings. They beat on that metric. Revenue came in better than expected, topping $2.5 billion. So they beat on both the top and bottom line. Overall sales jumping more than 20% on a year-over-year basis, helping shares right now jump more than 17%. They raised their gross margin outlook. They raised that to between 67 to 67.5%, and that comes even after factoring in tariff impacts, although they say those impacts will be minor. Hospitals are catching up on procedures from that were delayed again during the pandemic. They're expanding their minimally invasive surgery programs. That's a big win for Intuitive. Here's the thing, their bread and butter, the Da Vinci system, that continues to gain traction. Procedures are expected to jump between 17 to 17.5% this year. That's up from their prior range of seeing between 15.5 to 17%. That growth matters because every procedure drives sales and repeat sales. When you think about also the disposable instruments and accessories that come with every one of these robots. And we continue to hear the robotics conversation in a variety of sectors. And this is one of those sectors where they've taken, one of those industries where they've taken advantage of that with Intuitive Surgical. They've installed more than 400 new systems this year, including more than 200 of their newest model of the newest Da Vinci versus, to put that in perspective, last year that number was 110, so more than 400 this year. Huge jump, Nicole.
Nice to see the move here, particularly for the shareholders that were disappointed. This was over $600 late last year, dropped to $425, and has been on the downside of things. The shareholders needed a little boost today, and they certainly got it with an 18% gain now. We're also looking at Capital One. That's higher on earnings as well.
Investors breathing a sigh of relief on this one for Capital One because there were also some concerns about the integration of the Discover business. They say that is going well today. You see a lot of analyst activity around Capital One raising price targets off the back of these results. So shares are higher by more than 4% at the moment. In terms of how they performed on the most recent quarter, third quarter, adjusted EPS came in at $5.95. That was much better than expected, more than $1 better than expected. Revenue coming in at $15.3 billion, more than $15.3 billion, also better than expected again on both the top and bottom line. That was helped by stronger lending income, also fewer customers falling behind on their payments. So there was concern about their customer base because, this is obviously a different customer than the American Express customer. And it just shows that there is still some strength with the consumer. The consumer is still able to service their debt. Delinquencies in both credit cards and auto loans actually fell. So that, again, eases those fears that have been rising about consumer distress. Its auto loan portfolio holding steady. The CEO saying the bank is still on high alert to watch how private credit affects consumer finance because we've been having that conversation about private credit and some of the issues we've seen there. Again, they're saying their integration of Discover is going smoothly, and their integration expenses, they trimmed that to about 41 cents per share from profit this quarter. They also announced a $16 billion buyback program, so that replaces their original plan. So again, we know that is a signal of confidence, Nicole.
All right, and last but not least, we were talking about GE Aerospace. You covered it, how it was at a record, and now there's GE Vernova out with the quarterly results. Let's talk about that.
Yeah, and maybe two are better than one, and that's the message that we see here with the results of GE Vernova doing better than expected on revenue. Now, EPS was actually a miss, but EBITDA was better than expected. Adjusted EPS came in at $1.64 for EPS. Again, that was a miss, but the street doesn't care because one is swung back into the black, and two, EBITDA was better. Revenue coming in at nearly $10 billion, $9.97 billion to be precise. So The stock right now powering higher off the back of its results. Again, their sales were much better. That's basically more than triple from a year ago. Strong demand for both power and grid infrastructure. So that means GE Vernova is a beneficiary of that. Orders jumped 55%. That's the biggest gain since its spinoff from GE. So especially, you also saw strong growth in electrification and its gas power business, Nicole.
All right, a lot of names there. And Diane, I was just looking at two names that I love to watch. They're not as big. Winnebago today is up 25%, and Beyond Meat is up again, almost 50%. It's now a meme stock at this point. It's up 1,200% in 4 days. As Beyond Meat will now be available in Walmart. I heard that story this morning, and I brought some Beyond Meat for lunch. Okay, thank you. Good to see you, Diane King.